Hey guys, it's Sasha. Netflix reported their Q2 earnings last night and the shareholder letter opened with Q2 was better than expected on membership growth, which is a pretty funny way of describing losing 1 million accounts in the last quarter. The stock market has decided that this is a good thing because they thought Netflix would lose even more customers, you see, and the stock price already collapsed back in April when Netflix forecasted a bad Q2 coming up. So this drop was already kind of baked in, and so this morning Netflix is trading at 6% up in pre-market as I'm recording this video. The problem for me is that these Q2 results smell of desperation. And I'm going to share some thoughts on this because Netflix is not having a great 2022 so far. The share price is already down 66%, but from where I am sitting, the red warning flags about the stock are still waving, and I'm thinking there is a very real risk that it could yet get worse. So on the surface, if you look at the numbers, it kind of sounds great. Netflix posted a record revenue of $7.97 billion, and that is a growth rate of 8.6%, which is great because, of course, Netflix did particularly well during the pandemic, so growing today versus 2021 is really good. And hey, the strength of the US dollar has also adversely hit Netflix. The dollar has been performing very strongly in the last few months, reaching parity with the euro for the first time in the last 20 years. And because of that, all of the money that Netflix earns in countries outside the United States is worth less in dollars. Netflix reminds you that if they didn't have this issue, they would be growing by 13%. We're probably going to see a lot of very similar disclosures about the strength of the US dollar in this earnings season from other companies as well. So we have got record revenue. The numbers are going up despite the headwinds, and there is a 19.8% operating margin and $1.4 billion of net income. But then you start reading between the lines and going a little bit deeper, and it just doesn't quite look as rosy because this is the second quarter in a row that Netflix users have shrunk. There were 220.67 million users in Q2, which is 970,000 users less than in Q1, and Q1 itself was already 200,000 less than Q4 of 2021. And you can see that the number of Netflix users absolutely exploded during the pandemic, and we're now seeing a lapping effect. Last year, the growth was a lot slower because it was growth relative to those quarters in 2020 when growth was absolutely bonkers. Then we had the massive Omicron scare at the end of last year. I know it seems like that was a whole lifetime ago, but it was only in Q4 last year, just a few months ago, that we were having more lockdowns and more restrictions around the world, and we had a little jump in user numbers here as well. And in Q1, that number started dropping, and in Q2, it has dropped 5 times as much as it did in Q1. The big question is this a lapping effect that will just sort itself out, or is it a sign of trouble? Is it the case that Netflix users grew so much during the last 2 years that, of course, the rate of growth now is going to have to be slightly slower for a few quarters before returning to some kind of normal? Or is this game over and the start of some kind of a downfall for Netflix? Well, I think this is going to be a very interesting topic to discuss in the Discord with my Patreon and channel members. If you want to join, by the way, the link is in the description, so I'll see you in there. But here's a summary of what I really did not like about these Netflix Q2 earnings numbers. First, Netflix has been cutting costs by letting go of staff and offices. They have this sentence here that says, "We've adjusted our cost structure for our current rate of revenue growth." And as an investor, this is pretty concerning as a statement. They have spent $150 million on severance for their staff and paying off leases on some of their office space. Several pages further down in this same letter, Netflix also says, "We expect annual positive free cash flow going forward with substantial growth in free cash flow in 2023 versus 2022 due to our increasing revenue, solid profitability, and the successful multi-year evolution of our content model." But the problem for me is that these two statements in different parts of the same letter completely contradict each other. And I really do not like seeing things in quarterly earnings reports where the story just doesn't add up, because it indicates that what is being printed is not necessarily what the management actually thinks might happen. It sounds like a rose-tinted spectacle version is being put up here. Because if you genuinely thought that you are going to bounce back with substantial growth in free cash flow, which is a quote, in 2023, and you thought that you were going to explode revenues, blow up profitability, would you be adjusting your cost structure for your current rate of revenue growth by letting go of people that you wouldn't otherwise be letting go of? This isn't the getting rid of dead weight, the sort of cutting 10% of your staff every couple of years. They literally said that they had to let people go because money is tight. And the thing is, money is tight. If you look at Netflix's balance sheet, there are $46 billion worth of assets and $27 billion of liabilities, so it kind of all looks great there, except when you look at the assets pile, you realize that $32.5 billion out of that 46 is content assets. These are intangible assets that are probably going to be very difficult to convert into any kind of cash, and I'm guessing a large part of those assets sitting on the balance sheet is probably not actually worth anything at all. If you scroll down to the cash flow statement, you can see the problem. In the last quarter, Netflix spent $4.7 billion on making more content. So this is cash that they have sunk already, they've spent it, and that $4.7 billion is now part of the $32.5 billion of their content assets. But they have also amortized $3.3 billion of those content assets in the last quarter. Just think about that for a second. Their pile of content assets on a balance sheet amortizes at more than 10% per quarter. So 10% of those assets are just disappearing every single quarter. But a really important point is that the rate at which they are amortizing those assets is significantly lower than the rate at which they're spending cash on new content. This is really critical because it is the amortization number that goes into the P&L, not the much higher number, which is the real cash they're spending on content. Now, you would probably expect the amortization to be fairly high because when you make a movie or a TV show, you will earn the lion's share of the revenue from it in the first few weeks or first few months after you release it. And then go and look at the bottom of the cash flow statement. Netflix has $5.8 billion in cash as of the end of Q2, and at the end of Q1, that number was $6 billion. And 12 months ago, it was $7.8 billion. And at the moment, they have $7.5 billion in current liabilities and $14.2 billion in long-term debt. So their current cash pile is dwindling relatively fast, and their current ratio, which is the ratio of current assets, current liabilities, is approaching 1. And if it drops below 1, that will mean that the business has less cash and current receivables than how much they have to pay just to run the business for the next 12 months. So this is a problem, and Netflix has to urgently figure out how to either make more money or drastically cut costs. And we just talked about them starting to cut costs, we're getting rid of staff and offices, but then they also have a plan for making more money. And this is where it gets substantially more ugly, because their plan does not include giving customers a much better product, a superior offering, giving customers more value, which will make them more sticky, happy to spend more money. It doesn't include them making better, longer form, longer term content. What it does include is panic. First, in the last few months, Netflix decided to start acquiring random gaming companies. So instead of focusing on their core business and fixing it, they're trying to see if they can suddenly go and win in a hyper-competitive, completely different niche instead. Then on top of that, they've increased pricing significantly recently, and this is coming at exactly the same time as inflation is running right. Inflation has just been announced as being 9.4% in the UK this morning, 8.6% in Europe, 9.1% in the United States. Energy prices and food are absolutely through the roof. And many people are really struggling because their wages are not keeping up. And in times like these, when disposable incomes are tight, money is being squeezed, subscription services like Netflix are going to be first to go. Inflation is still climbing, and the Fed and other central banks have been very slow to hike rates, so inflation is probably going to continue climbing or at least stay high for a little while. So it's nice that Netflix thinks that their user numbers are going to grow by 1 million in Q3, but it's definitely not going to be a ride in the park, and I wouldn't bet my house on it. Netflix have also announced that they will offer a lower priced entry-level plan that will have ads. And I know they probably hired a bunch of extremely expensive consultants wearing the sharpest suits to come up with this masterstroke tactical maneuver, but if you let a monkey think about it for about 2 minutes, the monkey will very quickly figure out that the likely impact is not going to be quite what they think. First up, you are going to cannibalize your existing user base, and good luck making up for the difference in price with ad revenue from Microsoft. Second, in order to make any meaningful revenue from ads, people on this new plan are going to have to watch a lot of ads. There is a reason why TV channels have to show a lot of ads, and these TV channels do not spend billions of dollars on making the latest movies and the latest shows every single quarter. And here is some really simple maths. Netflix have this chart on page 5 which says that in June they got 1,334 billion minutes of viewing in the US in June. And further down in the same report, you can see this number here that says Netflix have 73 million paid memberships in the US and Canada. By the way, whichever junior analyst pasted this this blurry picture in this report instead of making a proper table, can you at least make sure that the quarters in this data line up with the rest of this report? Because this table has the latest quarter on the right, while every single other table has the latest quarter on the left. Maybe it's petty, but it's pretty basic stuff. It makes reading the numbers slightly easier anyway. Very roughly, if we ignore the fact that Canada is also included in these numbers because it's not a huge difference, 1,334 billion minutes divided by 73 million memberships equals 18,273 minutes per account per month. So that's about 305 hours per month per account in June. If we took out the Canadian accounts, that number would be even more redonkulous. So apparently those 73 million Netflix accounts in the US watched more than 10 hours of Netflix every single day in June. I think the issue here is that the Nielsen data is per person, not per Netflix account, and also many Netflix users share their passwords with other people, but even so, I am not sure I entirely believe these numbers here. Anyway, the standard Netflix package in the US costs $15.49. And Netflix haven't revealed how much this cheap package is going to cost, but I'm guessing it has to be substantially less than the basic plan that costs $9.99. So let's say it costs, I don't know, $4.99. So you will have to pay $5 a month to watch Netflix, and after paying $5 a month, you also have to watch a lot of ads. I don't know about you, but I look forward to seeing the public reaction to this one. But let's say that it does cost $5. So the gap between the standard package and that $5 is $10.50. Keep that number at the back of your mind. So how much can you earn from ads? Well, YouTube is a pretty interesting comparison, and YouTube tends to average around $4 per 1,000 views for people based in the United States. Because YouTube shares only 55% with their creators, let's call the total ad take per 1,000 views as being $7.30. And the average video length on YouTube is apparently 10 to 12 minutes, roughly in the 12-minute range. Now, you would probably agree that YouTube does a lot of ads. I am guessing you probably won't like Netflix if they show that many ads, and YouTube has been doing this for some time now. They're kind of good at this whole ad business, and I'm guessing Netflix will at first earn substantially less than YouTube from ads. But even if they matched YouTube immediately, and they made $7.30 per 1,000 views, where each view is 12 minutes long, that would equate to about $36 per 1,000 hours of video content. And remember, YouTube does ads before those videos, after those videos, as well as in the middle of those videos, and they have those banner ads to the right of this video, and Google is by far the biggest online advertising company in the world, so they benefit from basically being a monopoly. So there is absolutely no way in hell, no chance that Netflix can get even remotely close to earning the same money, but let's pretend. So at $36 per 1,000 hours of video content for Netflix, if the average US account consumes 305 hours of content per month or more, there's going to be something like $10.98, $11 per month in ad revenue. So if Netflix shows as many ads as YouTube, and they earn as much from those ads as YouTube, and they also charge you $5 per month on top of those ads, then they will make about the same money from those accounts as the standard account costs right now, because $10.98 plus $5 is $16, which is very similar to the $15.49 for that standard subscription. So you can see that the commercials there just don't stack up. And then on top of all of that, Netflix has decided that a great way to raise even more revenue is to go to war against their own customers who share their passwords. How dare they? Because imagine if you take those 200 million odd accounts and make all of them who share their passwords open a new account, and you're probably magically gonna have 400 million accounts overnight and double your revenue. That's exactly how it works, right? Well, that's roughly the plan by Netflix. What can possibly go wrong? They're already testing this approach in Latin America. I do get why they are doing it, but the real problem is that the pricing in the Netflix proposition today just seem to be too expensive for people to spend the kind of money that Netflix wants them to spend. The strategy of trying to squeeze every last dollar from the existing customers may not be the best way to try and get growth back on track over the next few quarters. So at the moment, Netflix is cash flow negative. They are losing customers. They say they will make back roughly 1 million customers next quarter after losing 1 million this quarter, and that's apparently good news. They're also spending more and more on content. But that content is not driving new people to Netflix, and their cash pile is depleting pretty fast as they are burning all of that cash on making that content. For me, the warning flags are just way too much to be interested in the stock, and I just personally don't see the value. The P&L is positive and looks healthy. But this is only because the huge amounts of cash that are growing, that they are spending on this new content, are not coming through as costs. The P&L doesn't include them. What the P&L does include is the amortization cost of that content that is being written down over time, and those amortization costs are substantially lower than the cash they're actually spending on making the content. In the last quarter, the difference between what they actually spent and their amortized value was $1.4 billion. And lo and behold, the net income figure for last quarter for Netflix was $1.4 billion. So the reality, unfortunately, is that this P&L profit is not real. Netflix have just built up a pile of long-term debt and spent their cash and converted those into these quarterly profits. Remember, if you're interested to sign up to my Patreon to join the Discord and discuss this in a bit more detail in the conversation, please check the link out in the description. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching, and as always, I'll see you guys later.